Natco Pharma just posted its strongest margins in a decade. But is it still a good buy for long-term investors? In this video, we dive into a detailed 13-part analysis backed by 10 years of annual reports, investor calls, and strategic data. Let's decode the fundamentals behind this pharma innovator. Natco Pharma Limited, founded in 1981 and based in Hyderabad, is a vertically integrated pharmaceutical company known for its focus on complex generics, niche formulations, and agrochemicals. Their multi-pronged business spans 6 verticals. Export formulations, especially to the US and Canada, via profit sharing with partners like Teva and Mylan. Domestic formulations, with leadership in oncology generics. APIs, supporting backward integration and cost efficiency. Crop health sciences, a growing agrochemical vertical. R&D and innovation including cell and gene therapy and niche molecules. Licensing and collaborations, especially in the US, anchored by litigation-driven market access. With 5 formulation plants and 3 API units, Natco's operational footprint spans India, North America, and ROW markets. Over FY 2015-FY 2025, Natco's revenue grew from Rs 891 crore to Rs 784 crore, an 18.1% CAGR. Net profit expanded at a 21.4% CAGR, from Rs 168 crore to Rs 883 crore. FY 2023 and FY 2024 were exceptional due to Revlimid's exclusivity, with margins soaring to 47% in FY 23. FY 25 revenue rose 16% YoY, net profit jumped 36% and cash flows remained strong. Growth was driven by complex generics, oncology dominance, and a Rs 90 crore land sale. Natco's strategy centers on 3 pillars: deepening complex generics through Para IV filings and first-to-file exclusivity, investing in specialty pharma and novel chemical entities like NRC 2694, diversifying into agrochemicals via its crop health sciences division. Its moat lies in aggressive IP strategy, backward integration, niche focus, and strategic alliances. By focusing on high barrier-to-entry drugs and maintaining a lean cost base, Natco avoids the volume trap common in generics. CEO Rajeev Nanapaneni is known for bold litigation strategies and strategic foresight. The company invests 6-8% of revenue in R&D annually, focusing on complex molecules and next-gen platforms. Capital is deployed efficiently, toward legal settlements, new plants, product pipelines, and occasional M&A. Dividend payouts are modest as earnings are reinvested for compounding growth. Governance practices are solid with full transparency. Though unrated by agencies like CRISIL, Natco's financials are rock solid. As of FY 25, net cash stands at Rs 259 crore. Debt is minimal at Rs 241 crore, debt to equity less than 0.05x, interest coverage greater than 30x. Current ratio approximately 3x. The balance sheet is robust, giving Natco strong downside protection and capital flexibility for future bets. Natco's product portfolio includes oncology blockbusters like Revlimid, sorafenib, and erlotinib, upcoming CNS and diabetes drugs like Semaglutide and olaparib, a growing agrochemical range, fungicides, herbicides, and insecticides, COVID antivirals, and emergency therapeutics. Its manufacturing network includes 5 formulation units and 3 API plants, all US FDA and EU GMP compliant. The company is investing heavily in capacity expansion, technology platforms, and R&D infrastructure. Domestically, Natco sells branded generics via a strong field force and hospital tie-ups. The US is its largest market, handled via partnerships like Teva. Canada is served through Natco Pharma Canada Inc. ROW expansion targets LATAM, MENA, and Southeast Asia. Strategic alliances, institutional sales, and Tier 2 city outreach support broad and deep penetration. FY 25 EBITDA margin stood at 39.4%, down slightly from 42% in FY 24. Margins remain above industry average due to Para IV exclusivity, in-house API production, focus on niche markets. Input costs are largely under control but partially exposed to China. FY 25 saw one-time costs, Rs 50 crore impairment in crop health, and Rs 25 crore chargebacks in the US as of June 2025. Market cap, Rs 791 crore, PE, approximately 4x versus 10-year median of TOM266 and peer average of NUM32x. PEG ratio, approximately 2x. Analysts estimate a fair PE of 12 to 13x with upside to Rs 1,012 per share. Yet valuation discounts reflect Revlimid expiry concerns, and future earnings visibility. Key risks include high reliance on Revlimid. Profits could dip 30% in FY26 post-exclusivity, U.S. price erosion and regulatory hurdles, ongoing patent litigation like Risdiplam, execution risk in crop health sciences, high R&D intensity without guaranteed payoff, supply chain exposure to China. These headwinds merit active monitoring. Natco is a unique mix of high-margin legacy products, strong R&D, and financial prudence. Key strengths: Revlimid-led profitability, strong balance sheet with RS3 500 CR cash, top 3 in domestic oncology, well-integrated, cost-efficient model. Risks revolve around product concentration, regulatory unpredictability, and earnings compression post-FY25. Investors should track FY26 margins, R&D execution, Semaglutide, NRC 2694, agrochemical profitability, Revlimid erosion impact. Out of 22 criteria, 19 fully met. 2 are neutral, typical for pharma. 1 clear concern, Revlimid dependence. Key wins, 10-year sales and profit CAGR over 10%. Operating margin over 30%. 0 pledging. Debt less than 0.05 times. PE less than 10. PEG less than 1. Top drivers: strong R&D pipeline, Semaglutide and Olaparib, global expansion, cash-rich balance sheet, agrochemical scale-up. Risks to watch: FY26 earnings dip post-Revlimid, Risdiplam litigation outcome, U.S. generic pricing pressure, CHS profitability. Key triggers: GLP-1 launch in India, FY26, NRC 2694 trial progress, margin trend in FY26 Q1 to Q3. Emerging market revenues. This video is for educational purposes only and should not be considered investment advice. If you found this breakdown valuable, hit the like button and subscribe for more detailed company deep dives.